It really has been a miserable 5 years for share investors in Australia. The global financial crisis was a black swan event. In other words, it was entirely unexpected. There had never been a substantial drop in residential property prices in the US since records were kept, so lending with property as security was regarded as safe by definition. The issuers of some prime mortgages also relied on diversification, having a large number of loans to different people, because in the past defaults had never been correlated. There had always been some defaults, but never all at the same time. In the end, property prices did fall substantially because they'd gone up by too much and there was oversupply. And when the prices fell by a large amount, a lot of borrowers defaulted all at the same time. We all know what happened after that. Banks collapsed, economies teetered, and countries flirted with bankruptcy. When investment professionals talk about long-term investing, they generally have 5 years in mind. It's extremely unusual for markets to provide a negative return over that period. However, over the 5 years since the crisis started in November 2007, the Australian share market has lost money at the average rate of 3% per year, even after allowing for the dividends received. The probability of this happening is around 2%. In other words, you could expect that it might happen once every 50 years. In fact, it was less than 50 years ago that we had the other black swan event we've already discussed, the oil crisis. This chart compares the two black swan events. The blue bars are for the oil crisis, and in the first year, 100% is the level of the market before the crisis began. In the course of that first year, the market went down by 18%. The green bars are for the global financial crisis, and once again 100% is the level of the market before prices went down. In this crisis, the market went down by 25% in the first year. In the second year of the oil crisis, the market traded between 60 and 88% of the pre-crash prices, while in the second year of the financial crisis, prices ranged between 45% and 78%. The third year of the financial crisis was a bit better than the third year of the oil crisis. By now you should be getting the idea of the chart. In the oil crisis, the market didn't exceed the previous peak until the 8th year, and that year was a beauty with the market going up by 60%. What many of us find amazing is that despite our miracle economy, the Australian share market has underperformed many others. At the end of December, the US market was only 7% below the previous peak. The UK market was still down by 15%, and despite the problems of Europe, the German DAX was within 5% of the all-time high. Meanwhile, Australia was still down by a third, along with most of Europe and most of Asia. There's two main reasons for Australian shares being where they are. I'm sure you've heard of the price-to-earnings ratio. It's sometimes called the PE ratio, or the PE for short, and it simply means the amount you're paying for profits or earnings when you buy shares. The two things that matter in setting share prices are the amount of profit and the PE ratio, what you're paying for the profit. The average profit or earnings per share in Australia is currently 20% less than it was before the financial crisis. This is partly because times have been tough, especially if you're not a mining company. But it's also because of all the capital that was raised during the financial crisis. Because companies needed money and they couldn't get it from anywhere else, they came to the share market with deeply discounted rights issues. In total, over $300 billion was raised, around a third of the total size of the share market at the time. And as a result, earnings per share were diluted by almost 15%. Before the financial crisis, the average PE ratio of the market was 18. Investors were paying 18 times profit for the shares they were buying. At the end of December 2012, the average PE was 15, around 20% less. The reason people are paying less for shares is partly due to sentiment. But in Australia, it's also because, up until recently, the interest rates available from term deposits have been much higher here than almost anywhere else in the world. So if earnings are down by 20% and the price multiple is down by 20%, that's the reason that our market is still down by around a third. So what's the outlook for the Australian share market? At the moment, the dividends alone are quite attractive. The average yield of the market is around 5%, and much of this is fully franked. If you allow for tax credits, the income equates to a pre-tax yield of over 7%. But if economic growth is slow and tough times continue, it's quite likely that earnings growth over the next few years may be muted. However, the average PE is lower than you would normally expect, and interest rates have been falling. At some point, confidence will return, and you'd expect the PE or price multiples to rise. So there's no clear indication that Australian shares are outstanding value, but there is some good buying to be had if you're selective. There is, of course, always the chance of another setback, and that leads us to the share investor's dilemma. Do I stay out of the market and sit on the sidelines while it goes up to 7,000 points? Or do I invest and thereby cause the market to crash? If it's any consolation, the market's better placed to suffer setbacks than it was before the global financial crisis. The market's now made up of survivors. Companies that had financial problems have either resolved them or they've gone broke. Balance sheets are stronger than ever, and business models have proven to be resilient. If you keep these points in mind, there are quite a few reasons for investors to be confident.